Hello, my friends. Today we will be talking about one big, beautiful bill act, OBBBA for short, and some of the provisions and how they affect you. Now, make sure to stick until the end because that's when I will be sharing with you some of the tax planning opportunities, ways how you can save money in real life, how you can apply it to your situation. All right, so let's get into it. First, we'll talk about the individual provisions and how they apply to you. So the first one is the educator expense deduction, and this applies to all my teacher clients. So as you know, in the past, you were able to deduct up to $300 of your classroom expenses as an adjustment to income. So you still get to do that, but now you get to deduct the rest of your educator expenses on Schedule A. So the first 300 still goes as an adjustment to income. Anything over that amount is going to go on Schedule A as an itemized deduction. So if you are itemizing, then you will benefit from keeping track of all of your classroom expenses. This applies to this year, so start keeping track of everything you've spent in the classroom, because that's something that we may be able to deduct for you this year when we're filing the 2025 tax return. All right, next let's look at wagering losses. So for all my gambling clients, as you know, the government via the IRS likes to discourage gambling. They do it in multiple ways. They really penalize you for having wins. And the way that you have always reported your wins and losses is your gambling winnings are a line item of your income. It increases your AGI. And then you get to deduct your gambling losses as a Schedule A itemized deduction, so only if you're itemizing. And that deduction was limited to the amount of wins, so you couldn't deduct more in losses than you had reported as gambling winnings, so it was limited by that. And what they're now adding is those gambling losses are first going to be reduced by 10%, so you can only deduct 90% of your losses. And then we're still limiting it by the number of wins. So depending on how many winnings versus losses you have, you may or may not see a difference on your tax return, because it will apply if you had more winnings than losses, or about the same amount of winnings and losses, because then you're reporting, like before, all your wins on the first page of your tax return as income. It increases your AGI. And then if you're itemizing, you will first look at your losses, take 90% of that, see if that's bigger or less than your wins. And then if it's more than your wins, then you will still limit it by how many wins you have. And that's going to be your itemized deduction for the losses. So again, not very positive for gambling, but that's how the government is going. They really dislike people gambling. Next provision has to do with no tax on tips. So up to $25,000 per year of tips is going to be now subject to deductions. Sorry, my kitty is out. And I am back. The kitty is out, and we were talking about no tax on tips. So up to $25,000 per year of tips can be deducted. And the way that works is, again, you're reporting all your tips as your income. So that will increase your AGI because you have that additional income. But then there's going to be a separate deduction. It's not itemized deduction. You don't need to itemize. It's just going to be another line item on a tax return where you get to deduct it before you arrive at your taxable income. So up to $25,000 will be deducted, and this is a tax break that ends after 2028, and so it does not reduce AGI, but it does reduce your taxable income. And there's going to be also income limitations, so not everybody gets to have it. Next item that I'm going to discuss is the state and local tax deduction is back up to $40,000. So for those items, those people that itemize your deductions, you will know that since Tax Cuts and Jobs Act of 2018, we have been limiting how much state and local taxes, and that includes the taxes you have withheld from or paid to your state governments, and also your property taxes. Combined, you could only deduct $10,000 on your Schedule A as tax deduction. So now they're upping that from 10,000 back to 40. So it's a much larger deduction you'll be able to take. However, it does phase out after $5,000 in AGI. So if you're a higher income earner, that deduction will start to phase out and it will not go below the 10,000. So it's not going to be worse than it was, but it only applies really to people that make less than 500,000 in AGI, adjusted gross income. So that's a nice little return of the state and local tax deductions that we've lost in 2018. Let's see. Next up, there's going to be this applies to owners of beauty services businesses. So FICA tip credit is extended to beauty services. FICA tip credit is something that the owners of restaurants are familiar with. That's something that you can get a credit for some of the FICA taxes you pay on your employee tips. And now that's getting extended to beauty services, so that includes barber, hair care, nail care, aesthetics, and body and spa treatment will now get that same FICA tax credit that was relevant before for just the restaurant owners. Overtime deduction. All right, so you can get up to $1,250 or $2,500 on a joint return. So it's the quality. So this has specific requirements. It's a qualified overtime compensation. So if you're you must be required under the FLSA to be a non-exempt worker, and so typically it'd be somebody who, for example, if you're a covered non-exempt worker, you get paid 1.5 times your regular wages after you work your 40 hours for the week. And what this will do is that amount, that overtime amount, that 0.5 amount is going to be deductible. So for example, if you normally earn $20 an hour and you got $30 an hour in overtime, then that $10 difference for the time you worked in overtime, that's going to be deductible up to these limits. So it's not the full amount of overtime pay, it's just that additional half or whatever that they pay you. If they pay you a time and a half, or if they pay you double your rate, then that second rate will be deducted. Now, it phases out after the limit. You lose $100 for each $1,000 over limit, and the limits are $150,000 for single or $300,000 for a joint return. So once you reach those limits, you're going to start seeing a phase out. This is designed for lower income taxpayers. Next up, the much discussed and little understood senior deduction. So here you get, this is not tied into Social Security income. This is for all seniors, anybody that's over 65 years old. They get up to $6,000 or $12,000 on a joint return. Again, this will end after 2028, like many of these other tax perks. It also has let's see, it's similar to exemptions in the past. So before the Tax Cuts and Jobs Act and all the major changes, the sweeping changes that came with that, before that we had exemptions for each person, and the seniors and the blind had a bigger exemption. So here, this is similar to that. And basically, thing to keep in mind here is it's also tied to your income. It gets phased out after certain levels. So this is something where tax planning can be incredibly useful. So if this is something that you think may apply to you, if you're a senior, you're over 65 years old, and you believe that this may affect you, you have on a higher end of income, come seek us out or another tax accountant and have them help you plan for this change, because it can affect you positively or negatively depending on what that is. All right, up next we have car interest deduction. So this is a new one. It's a little controversial, but this, first off, it only applies to people who are buying cars now. So if you already have a car prior to 2015, it will not affect you. This is only for new financing. So they're trying to sell more vehicles, and what they're doing is basically just like you have a mortgage interest form 1098, you'll get a very similar form 1098 for your vehicle purchased in 2025 or later. And so usually if you have at least 600 in interest, you'll get that form, and up to $10,000 of interest will be deductible. It would be a very expensive car to have $10,000 of interest, I would guess, but then again, cars are expensive. Those are the limits. You get up to $10,000 in interest deduction on a new vehicle that was purchased after this came into law. Other changes: adoption credit of up to $5,000 is now going to be a refundable credit. So you can, even if you don't owe the taxes, you can still get that credit back. 529 plan changes. Elementary or secondary school expenses, you can now deduct $20,000. That limit went up from $10,000 per year to $20,000, and also these funds can now be used for qualified post-secondary credentialing expenses. So those are some of the changes. Let's see, qualified disaster loss, $500 deductible, no longer 10% of AGI if it's a declared disaster. So used to be the disaster losses were subject to a floor of 10% of your adjusted gross income. So any loss less than 10% of your annual income basically wasn't deductible. Now the deductible is just $500. So you can deduct a lot more of the qualified disaster losses, and with all the natural disasters that have been happening around the country, that's going to help a lot of people that are in a really bad situation. Green tax credits ends on September 30th. So if you're planning to buy an electric vehicle and you would like to get a credit, you have to get it before September 30th. Go out and get that vehicle now, because any vehicle purchased after September 30th will lose that tax credit. Now, residential clean energy credits will end at the end of this year. So plan to have that installed and that money spent by December 31st of 2025 before the residential clean energy credits go away. Other new changes is something called the Trump accounts. That's the name. That applies to 2026 and beyond. So any babies born in 2026 and later will get $1,000 deposited. Actually, right, so we'll have $1,000 deposited to their special IRA account. So the Treasury will create a new account. The details are not known yet, but basically they'll be depositing $1,000 for each child that's born in 2026 and beyond. And that money supposedly will grow, and then when they're ready to retire in 60 years, they'll have some savings, and maybe it'll encourage them to save other money into their accounts, but it will be a separate account just for the Treasury. Okay, HSA changes. So the health savings account was something that was only used with the high deductible insurance plans. So now this allows high deductible health plans to offer telehealth. You can also have HSA now in conjunction with a catastrophic plan, and concierge care can now use HSA. So if you have a concierge doctor, and that's when it's also called direct primary care service arrangement. So if you have a primary care doctor, they can now that's offers concierge service. You can use your HSA to pay for that. Another area that has changed has to do with charitable donations, and basically there's some changes. If you recall, around 2020 there was a couple of years where you can deduct your deduction up to a certain dollar limit above the line, so without having to itemize. They're bringing that back again and they're increasing the limit. So you can now have a cash deduction for people who are not itemizing, above the line deduction of $1,000 single or $2,000 joint. So you can deduct that amount without having to itemize your deductions. So if you have any charity, up to 1,000 if you're single, up to 2,000 if you're joint, just make sure you have all your receipts. Those are still required, but you can deduct it even if you're not itemizing. However, with that comes also a drawback. So if anything over that amount, if you are itemizing your deductions, has now a 0.5% of an AGI floor. So depending what your AGI is, a certain amount of your cash donations or non-cash donations will no longer be deductible. You will have that floor amount, and anything over that floor will be deductible. And that's all I have for the individual provisions. There's more, but these are the highlights. Now let's take a look at the business provisions and let's go through that. So first one, bonus depreciation is now 100% for this year, so they're increasing it back up to 100% for property placed in service after January 19th of 2025. And the reason it's January 19th of 2025 is because January 20th, 2025 is when the current administration went into office. So they wanted to commemorate that, I guess, with increasing the bonus depreciation as of the date that they're in office and not before. So anybody placing property in service in those first 19 days of this year will still have the bonus depreciation at the older rates according to this OBBBA. Now, let's see, there were changes made to domestic R&D expenses. So those changes are treated as a change in accounting method. And there's a lot more to it. There's very specific things. We can amend returns going back to 2022 to institute those changes. We must make election on expenses now or over time, so we can make an election how we want to treat those expenses. And again, we can backtrack it to 2022. There's a tremendous amount of tax planning opportunities with this change. I'm more than happy to work on that for you. So if you have any questions regarding R&D and you think that that might apply to you in this year or in prior years, 2022 through current, just reach out to us and we'll work with you on figuring out what the best option is. Now, Section 179 deduction limit is now 2.5 million, so they upped the limit for Section 179 if that applies to you. This interesting one, so there's a new qualified production property deduction. Now what that is if you have you can now expense a commercial building 100% depreciation in the first year. So it allows you to do a special depreciation allowance for qualified production property. So you can expense a non-residential real property, the property that usually was deducted over 39 years, and it has to be used in qualified production activity. And that's the important part here. And basically the goal is to incentivize businesses to have production facilities in the United States. So this is only applicable if if the building is used to manufacture, produce, or refine tangible personal property. So offices, administrative services, lodging, parking, sales activities, software development, or engineering is not deductible for this. So it has to be actual manufacture, production, or refining of tangible personal property. And they specifically carve out restaurants, so no beverage or food production. So this is very specific rules. But in those situations, you can deduct the entire building in the first year. So that would obviously benefit some and not benefit a lot of other taxpayers. But some may want to take a large deduction this year, and they can do so. So qualified small business stock, QSBS, they're basically expanding it. It used to be that you had to wait 5 years for 100% deduction, and that's still the case. But they're now allowing a smaller deduction in earlier years, so you can get a 50% exclusion after 3 years, 75% exclusion after 4 years, and 100% after 5 years or more of that business. And they're also expanding it to 15 million as of 2027, which would be 3 years from now. Other business changes, the Forms 1099-K are back to being $20,000 or in gross receipts, so 200 transactions, and that goes retroactive to the beginning of this year. So that means that you won't get a 1099-K unless you have 200 transactions or $20,000 from your credit card processing, so that makes things a little bit simpler. If you received a few $100s, a couple $1,000 from your friend, you will no longer be receiving Form 1099-K, so that's great for compliance, makes things easier, just makes more sense. Also, Form 1099 NAC is increased from $600 requirement to $2,000 requirement, which is nice. However, that only applies for payments made after 2025. So for 2025, that limit is still $600. So by January 31st of 2026, we'll still need to issue Forms 1099 NAC for all of our clients who had over $600 in payments to subcontractors and other payments that were not using a credit card. Now, let's see, let's keep going. Yes, I won't go into details, but ERC fraud, that's the employee retention credit that goes back to 2020, that it has much higher penalties now. So they're really going after the unscrupulous preparers and unscrupulous taxpayers that were filing those forms to get as much credit as they could, for which they didn't qualify. Now those penalties are much higher, so that will discourage people from pursuing those years of credits. Qualified opportunity zones, they're just changing that. There's not much, I'm not sure if that applies to anybody here, but happy to explore. If that applies, just reach out. Remittance transfers are now subject to 1% excise tax. Okay, so what that means is when you're transferring money by someone in the US to someone in a foreign country, you will now pay a 1% excise tax on that transfer, and that applies to cash, money order, or cashier's checks. Planning considerations. All right, so this is that part of the video where I promised you we'll talk planning. So things to keep in mind is that senior citizens can lose tax benefits and increase medical costs due to IRMA based on their gross income and AGI. So this is an opportunity for us to plan what can be done and how we can change their income. There are certain strategies we can employ. So this is just a great opportunities for us to work together to make sure that you're getting the most of your deductions and you're not losing the deductions due to your higher AGI. Qualified charitable distributions could be one way to work through that. Performing road conversions several years before Medicare age is another way that we can work on minimizing that income in 65 and over age, because then you can withdraw from road that's already been converted and not have tax implications in the years of withdrawals. And just to know that some seniors will have difficulty paying for health insurance due to the premium tax credit changes, so there's going to be more to that. Also, we can tax plan how much of property is expensed during the tax year for property placed in service in 2025 and beyond. So we have now the expanded bonus depreciation, we have the Section 179, and of course that's a good planning option for us to use depending on your situation. If you wanted to opt out for the entire class, which is for a specific item, it's treated a little bit differently. We also need to look at how it's treated on a state level. So that's something that we can help figure out with you. And of course, the qualified real property, if you're placing a manufacturing building into production, we can talk about that and see if it makes sense to depreciate 100% of the cost of that building in the year it's placed in service. And there's other opportunities, for example, to move income generating activities to non-granted trusts. So each trust can utilize the $40,000 state and local tax deduction and the 199A deduction amounts. And for gamblers, and this is something that's not new, but this is something I've been trying to tell my gambling clients for years. I know it's not fun to do that, but please, please, please use session tracking, because that will really help you. So session tracking involves recording at the time that you're gambling how much was won and lost in that session. If you can give me that data, then we do not need to report separately your income and separately your losses from gambling. But with all those limitations, we can actually net them on a per session basis, calculate that, and that will greatly save you in taxes. So if you can, please use session tracking. Seek us out for more. And this is basically the highlights for the OBBBA, One Big Beautiful Bill Act of 2025. Thank you for listening. If you like this video, please hit that subscribe button, like us, follow us on social media, and just reach out to us. We're always happy to hear from you, and if you leave us a comment, we'll be sure to answer it. Thank you so much. I'm Angela Freeman, MBA, EA, Freeman CPA. Take care.